Welcome to the One Hero podcast, where we answer Malaysians' burning questions about personal finance with fact-based answers.
Stashaway markets itself as a platform that can help investors build their wealth, one step at a time. There's no minimum amount to start with, and you can choose from an array of investment options depending on your risk tolerance and interests. Their fees start at 0.8% and go as low as 0.2%. For Malaysians who don't want to or frankly don't enjoy any kind of active investments, Stashaway can certainly appear like an attractive option to grow their wealth. But is 0.8% too much to pay for their service? Welcome back to the One Hero podcast. Today we're asking, are you paying too much for Stashaway to help you invest? To answer this question, we should start by understanding how Stashaway works. So John, can you explain to us how exactly does Stashaway work?
Before I even go on to explain how does a robo-advisory or a Stashaway works, I think the concept is similar across all robo-advisories. They mainly buy what we call an ETF or an exchange-traded fund, and they usually buy them in baskets. Now, before we even go to most robo-advisories in the world will actually go through this, which they buy an ETF based on a specific algorithm that they actually consider proprietary to themselves. So the question will be, what is an ETF? An ETF is actually a basket of stocks. And usually ETFs are structured based on what we call an index. Then the next question will be, what is an index? So an index is actually a set of rules that fits stocks into this basket lah. And this concept, even though not pioneered by this guy called John Bogle, he's the guy who actually founded Vanguard, but he was the guy that was considered to popularize it and to bring it into mainstream. So an index is actually like the S&P 500 or the Standard & Poor's 500. It is the top 500 companies by market capitalization of an exchange. In this case, the Standard & Poor's. So an S&P 500 index, let's just say one of the largest market cap companies in the world today is Apple. So when your market cap is large, let's just say a few trillion, 1 to 2 trillion, then the weightage of their inclusion into this index will be big lah. So you think about it, it's like, okay, name the largest market cap in the world today. You've got Apple, you've got Microsoft, you've got Amazon, all that kind of thing, right? In the past, let's just say 10 years ago, who were the guys who were the biggest? You have people like ExxonMobil, you know. I mean, today they're not popular. If you look at the S&P 500, probably 15, 20 years ago, you have guys like ExxonMobil, you've got guys like Walmart, you've got guys like this. So it changes based on the weightage of what we call the market cap. Now, for those who don't understand what is market capitalization or market cap for short, it is just the price of the share multiplied by the number of shares. So why do we use market cap? Market cap, hypothetically, if you have the value of the market cap, that's the value of the entire company if you were to buy the whole business. So let's just say Apple is 1 trillion. If at $1 trillion, you can buy the whole of Apple, technically. So the larger your market cap, the larger your index inclusion.
Yeah, to that point, so like that's also like how like public companies can also take themselves private back, right? If they buy all their shares.
Precisely. Yes, yeah, precisely. So you think of the market cap as if you were to buy the company whole or to take it private, that is the entire price you would pay at the market today to get it back lah. Yeah. So I went all the way from ETF to an index. An index is actually weighted by their market cap. So the larger your market cap, the larger your weightage on the index. Follow me so far? So, yeah.
So like what happens is all the companies will be selected into the index automatically. Is that how it works?
There is a cutoff point. So yeah, so if we were to look, let me just S&P 500 components, okay? So the biggest right now, it's Apple, okay? the weightage is about 7.4%. Microsoft is about 6.7%. So it's purely based on market cap. If your market cap drops, then you're off the list. You get what I mean? So right now, the smallest guy, the number 500, let's look at it. The number 500 is actually Fox Corporation, the news channel and all that, okay? Their weighting on the index is 0.009%, okay? So what happens if the market cap of Fox drops below the current lower threshold, right? It may fall off the index. That means the fund manager, the index fund manager of that ETF will have to sell it off because it's no longer part of the index. And then if Apple's market cap goes, let's say right now it's about, I think, 1 to 2 trillion. If it goes higher than that, that means it's a bigger component, the S&P 500. He has to go and buy more Apple shares.
So like, let's say if it happens that Apple grows and take up more market share, though, so it will also mean that some companies get kicked out, right? At the same time,
they will still be 500, but the weightage will be less and less because it's based on market cap. No? So the 500 will still be there, but then let's say Apple grew bigger, and then the guys remain stagnant, then their weightage will drop, but then Apple's weightage will grow because of the size of the market cap. Yeah.
So the next question is like, why follow the S&P 500 anyway?
Because you see, when you want to create an index, this is the rules. And the easiest way to benchmark is actually market cap. Yeah. Actually, this indexing or this component is very similar to a lot of these indexes around the world. So in Malaysia, we have the FTSE KLCI, Kuala Lumpur Composite Index, which is top 30 companies in Malaysia by market cap.
Okay.
So in the past, Sapura Energy used to be on the list, you know.
Okay.
Sapura Energy at that point of time, I think it was about 30 billion, if I'm not mistaken, market cap. Then it dropped all the way down to 2 billion, and then after that, it was lesser than that. So it fell off the KLCI index.
That's interesting. Okay.
Yeah.
So I guess we could also say that by following these, like the biggest companies, right, we could also get an idea about how the entire market is going. Can we say that?
Precisely. Yes. It gets a pulse because a lot of people look to the index for the temperature of the market because it, like, for example, the S&P 500 is very diverse. 500 companies, various industries, various sectors. So when the S&P is down, then the climate or the temperature of the economies, generally, it can be induced that it's down because these companies include people like ExxonMobil, Johnson & Johnson, JP Morgan. So you've got banks, you've got tech companies, you got Procter & Gamble there, you got Eli Lilly. Eli Lilly is a pharmaceutical company. You've got MasterCard, Home Depot, right? So such a broad-based representation means like, hey, if all these guys are down, that means the economy is roughly down. That's why... So back to your early question of why use an index for an ETF, because it's easy. The rule is actually very simple, which is free float, free market cap. Okay, free float of the shares, market cap. And when you have such an easy index to actually administer or to execute, that means there's less work for the fund manager, the ETF fund manager, so-called, to be able to administer that because they're not stock picking really. It's purely based on market forces. Market goes up or down, weightage of Apple goes higher, lower, Microsoft goes higher, lower. The work is not done by them, it's done by the market. Their job is just following the index. If the index goes bigger, for the weightage goes bigger for this company, they'll buy more. If it goes lesser, then they'll sell. So that's why the fees they charge on ETF is very, very low, because this is what is known as passive investing. There's no active stock picking.
I see.
So that's why you see the management expense ratio all very low, you know.
I see. So I'm just trying to understand. So StashAway, right, basically acts like as a middle person, helping you to buy ETFs.
Yes.
Am I understanding this correct? Okay, so if ETFs are already not really active, they're like passively managed, right? So what exactly is StashAway offering on top of that?
It's a fantastic question. So let's take through the process of if you were to buy an ETF directly. Now, in Malaysia, there's less than 20 ETFs. as I remember, right? I doubt it has more than 30 today, lah. But I know that the Malaysian ETF market, a lot of work has been done by Bursa to try to promote it, but the struggle for Malaysia to actually thrive as an ETF market is difficult. Why? For a very simple reason. KLCI 30, it represents like 70-80% of it is actually GLC. And they are conglomerate, very, I would say, very stable industries. There's not much growth. You don't have an addressable market that's outside of Malaysia, most of it. You talk about the Maybanks of this world, you talk about public banks, a lot of banks, a lot of GLCs. PCAM is part of it. Yes, they have an outside market, but there's only one of the 30. So in Malaysia, if you follow just index-based investing for KLCI, it doesn't really represent a good growth prospect or a good broad-based prospect of the Malaysian market. But if you compare to the S&P 500, it's like 500 companies, global presence and all that kind of thing. And it actually gives a better representation of the broader market. So the struggle for a Malaysian guy to buy an ETF in the past was this. You have to open a foreign broking account, okay? You have to transfer money in terms of most likely US dollars or Sing dollars or whatever currency that, I think the biggest market is definitely still the US. And then you have to buy that off a foreign exchange. So you talk about 10, 15 years ago, it's very, 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 very difficult because you've got Forex to handle, you've got know your customer procedures you have to handle, and then you're dealing with a foreign broker, and then the brokerage fee is very high. So what the StashAway does, what's the value that StashAway brings? It's very simple. Everything is done from your mobile, your KYC, your know your customer, your anti-money laundering checks are all done online. You don't need to worry about Forex. You don't need to worry about ETF selection. You don't even need to understand what is an ETF. Totally don't need to, because they do all this selection for you. And for them, the risk is actually very, very diversified because ETF itself is diversified. Then you buy a basket of ETFs, you're even more diversified, which actually is also a con for most, it's actually a detriment for most investors, which I'll share later. But to your question is that what value does StashAway offer? It offers convenience, frictionless. So compared to ETF, foreign brokerage, transfer money, you have to handle Forex. If you go to StashAway or you go to most robo-advisors that do US-based ETF investing, you bank in Malaysian currency, everything is done through your mobile app. So that experience is so much more frictionless, I think, and that's a good starting point for most beginning investors, actually.
And if we actually look at the fees, right, in absolute terms, it doesn't really sound like much. So from the pricing table, we can see it's 0.8 on your first 50,000 ringgit deposit on the general investment products. Then the additional deposits, I price it on a graduated pricing model. So my question is, if we look at this fee, right, and then really consider it compared to the alternative, is it actually worth paying for? Is 0.8 actually cheap or expensive to pay for StashAway to manage ETFs for us?
Okay.
To do what exactly you were saying? Yeah.
For the beginning investor, you're first starting out, you want to, in a way, force yourself to do some investing. I think it's a good way to start. But once you gradually get a hang of understanding the market, get a hang of doing a little bit, think of it like this. I come back to IKEA again. It's very simple. So IKEA, they're very famous for what we call flat pack furniture. That means they give it to you in a box. You go back with some tools, with a little bit of DIY, you can get the furniture up, but you pay a fraction of the cost. Okay. But this is the reverse. Okay. They are the IKEA guys with installed furniture for you. Everything is done. They'll send you logistics, whatever. But you pay a 0.8 to 0.2 lah. So if you want to save and you want to DIY yourself and you want to customize, especially now with StashAway coming up, the flexible portfolio, why do I want to go through StashAway when I can actually customize my own ETF myself, buying and selling directly on the market? So you think about it, an ETF is bought and sold like a normal stock on a stock market. The beauty about buying an ETF is you don't need to do what we call a fundamental research on a company, and your risk is so spread out because it's diversified. It's the S&P 500, right? Half of your companies fail, you have the other half still giving you the return. So you talk about risk, I think it's very, very, what do you call it? Reduced, very much reduced. Then you think about it, do you want to pay an extra, if you've already like gotten familiar with how to buy and sell an ETF on the open market, do you really think it's worth paying that extra? And don't forget, it's not one-off, it's recurring. So if you're just paying one-off, it's fine. But if you're paying recurring, ask yourself this, just transferring money and then keeping it in US dollars, just opening an account with a foreign broker, which is so easy today. It's like, you know, you can, even like the guys like Kanaga, even guys like Rakuten, even guys like Momo, all of them are here. You talk about 10, 15 years ago, maybe I will have to agree. It's a little bit difficult, right? But today you've got Interactive Brokers, you've got CMB Prosperous, you've got all these guys that, you know, allow you to do buying and selling or broking, trading US shares for $6, right? It's so cheap, right? I think once you graduate and you know how to, like you're the duck, you just landed in water, maybe first time cannot, but once you know how to paddle a little bit, right? I personally don't think it's worth paying for the fees. Might as well you just go and buy your own ETF. Yeah.
And I think I also came across this Reddit thread where someone actually talked about the compounding of these fees over time.
Correct.
So if we look at the figures, right? Okay.
Yeah.
Okay, so if we were to look at these figures, right? If you were to put in StashAway, so they're giving some examples here.
Yeah.
So the same amount of money put into StashAway minus the fees of 0.8%, the fees also compound, right? Because some of your deposits, they'll put 1% of that in cash, so they can deduct as fees, right? So some of that money, you know, gets like taken away as fees, and you know, multiply that. I mean, compound that over 5 years, right? So on StashAway, you get a return of 13,787, and then what is this, John? URTH?
Oh, it's just an ETF. It's an ETF.
Also ETF. Okay, so
SPY is also an ETF.
Okay, so these are just different ETFs. I assume this guy has done the calculations, and then in the end, right, this on the URTH one, you got 14,912.68, and then SPY one, 17,805. All of them much more than whatever you get from StashAway because of that, you know, like your expense ratio. Yeah, and some of these returns, it balloons over time, right? So these are something that people should also consider.
Correct.
Like the question is, John, we talk about buying your own ETF. Is it actually, like, if I'm a beginner, I actually don't have any ETFs. I've never bought ETFs. Someone like me, right, to learn how to do that, how long would it take? How complex would it be?
I would say ETF comparatively to buying individual shares, I think 1 week, if you read 1 hour a day, you'll be almost like an expert already. Seriously. Because it's very simple. The rules of ETF, like what I explained earlier about indexing, is just really broad-based index. So they're not trying to time the market. They're not trying to pick a certain, even though they are sector-specific ETFs, okay, which we'll come to later. But most of the large ETFs like URTH is actually BlackRock iShares MSCI World Index. Okay, now I know there's a mouthful. Okay, so MSCI stands for the Morgan Stanley Composite Index. So the S&P 500 is mainly US based because it's the top 500 companies in the Standard & Poor's Index. Okay, MSCI, it's a global index, world ETF. So they'll take the top market cap companies around the world based on the MSCI index, and they will buy a basket of all those stocks. So once you understand the concept of indexing, actually you don't need to do much research already. You just need to understand the concept of indexing and how the ETF is bought and sold. That's it. Virtually, because the standard around the world, there's only a few, only S&P 500, MSCI, emerging markets, world ETF, or then you have sector specific, like you just want to do healthcare, then there's a healthcare specific ETF. You don't actually need to really go through all the list of the, they will just pick the best, not the best, shouldn't use the word the best, they will pick the top healthcare companies in the world based on market cap, and then they will just buy a basket of all of it.
I see. So even if you want to like do a thematic investing, that's how you can do it as well. Okay.
Correct.
I mean, if someone were to just spend like a whole week to study this, they can save up to all of these fees, which over time compounds, right?
Correct.
And I think on top of that, if you actually know what you're buying,
yes,
there's also like that removing that risk of ignorance.
Yes, precisely. And you take control. In a way, if you were to talk about like ETF and Warren Buffett and Munger, obviously, they keep on harping on passive index investing is because the rules are very simple. The rules of engagement are very simple. Market cap. And naturally, a business that can outlast or have longevity, they will remain on the index as like Exxon, even though, like I said, 10, 15 years ago, they were right at the top, number 1 on the S&P 500. Now they're probably number, I think, let me check. It's number 12 or number 15. Okay, they're number 11, ExxonMobil, okay? So you don't need to worry where they are because the index will do the job for you. That means the company has reduced its profit, reduced its revenue over, and is falling out of favor because of ESG. Whatever reason, the index rules will self-sort for you. So the work is in a way done for you already, in a way.
Yeah, it's true, because like I'm just trying to get my head around that. Okay, so let's say it takes a maximum, like, let's put 1 month to learn how to do it, and then I can save on the fees forever, right?
A lot,
and just
pay
on the ETF very low fees, right? I think it's 0.2 max, is it?
Okay, it depends. So earlier, remember in the podcast, you asking me about why certain ETFs have an expense ratio of 0.09, and then something, all of a sudden you see an ETF of 0.9, which is like 10 times the expense ratio. Right? Most passively indexed ETFs has a very low expense ratio because the rules are very simple. S&P 500 or MSCI World Index. Okay. Now, when you go into specific thematic or sector selection ETF, where the rules are not so straightforward, that's where the expense ratio goes up. So if you go and think like healthcare, I don't know if you noticed just now, I show you the healthcare one. It's a little bit harder because the index is not that ubiquitous or not that obvious. It's not generalized, okay? So they may have to come up with certain specific rules to include these companies on the index. That's where the expense ratio gets higher. The more actively managed the ETF is, the higher the expense ratio. So if you go and look at ARK Invest, the expense ratio is among the highest, 0.7, 0.9, sometimes even 1%. So like StashAway, right? If you think about it, if they are buying ARK, you're paying 0.8 to StashAway for this frictionless experience. And then you have to pay ARK another 1%. So you actually, you're paying 1.8, you know, which is almost active fund management fees already.
Almost like unit trust investing already, right?
Yeah, exactly. So a lot of people don't realize this actually.
They don't, because like the way I think when people buy StashAway, sometimes they don't understand what they're buying into. They think that StashAway is an asset class.
Yes.
Right? Like unit trust, right? It seems like the same thing. StashAway, unit trust. Oh, I'm also DCAing, right? Like dollar cost averaging, like 100 a month, a month, force myself to save this amount. It feels like a unit trust already. Correct. But it's not, right? It's not even an asset class.
Yeah. The original underlying asset class is still equities or stocks or bonds or commodities. Commodities is like most likely a futures contract. Okay. So if you buy through, let's just say we take two investors, right? One guy that buys the ETF directly and one guy that buys through StashAway. So let's see how many layers of ownership this guy has to go through. Let's just say like for you, Louis, you buy through StashAway, and I buy through foreign broker, let's say Interactive Brokers. I open an account in Interactive Broker, I buy an BlackRock iShares MSCI Global Index, okay? My ownership of, let's just say, Apple or whatever stocks that is in that ETF is not directly under my name, it's under BlackRock, because BlackRock bought those shares, okay? So it's me, BlackRock, and then equity of that company. But if you're buying through StashAway, now imagine this, Louis buy through StashAway. StashAway will buy an ETF, let's say a BlackRock iShares or a Vanguard S&P 500, right? And then Vanguard will buy the equity, okay? So you're 3 or 4 layers removed from the actual equity itself. Obviously, the best is you buy that original equity, then you own that shares in your name. But obviously, for frictionless investing, you don't want to do active study of the stock, then this is one way. But I want people to be aware that, let's just say, and it's very, very low probability a Vanguard just collapse. Okay, a Vanguard just collapse.
Okay.
Now, how can you take your browsers? You cannot take your browsers directly to Vanguard because you don't own the ETF directly to Vanguard. You own it through StashAway. So you have to take your browsers to StashAway, then only StashAway takes the browsers over to Vanguard. But if you are buying directly on the exchange, you kind of like can take your browsers to BlackRock, even though they're the largest asset management company in the world. They may not care because you're a Kuchi Fry investor, but at least it removes one layer, right? So yeah.
But on StashAway's website, right? So there's this question that's like, okay, why don't I just invest on my own? Why don't I just buy these ETFs on my own? So they're saying that there are minimum trade sizes and high transaction costs imposed on the account, and this makes investing as individual costs prohibitive. So what do you think about that? Is it actually like, what's the minimum trade size for an ETF?
You can buy one share. BlackRock iShares MSCI World ETF is $120. So if you go and buy a unit trust in Malaysia, what's the minimum to invest? Is 1,000 ringgit. Here, you can buy one ETF that has a global index that's $120, which is like 600 ringgit. So I don't know whether that's prohibitive. I don't think so. That statement that you just read out is actually a defense for ETF itself, not just for StashAway.
Oh,
you think about it, right? You say prohibitive cost. Yes, if you want to buy directly Amazon, you want to buy directly Google or Apple. Yes, I agree. But what's stopping you from buying an ETF direct? It's only $120. Sometimes even, let's see, Vanguard S&P. Let's see, what is Vanguard's S&P 500? Vanguard ETF price. S&P. Okay, it's a little bit more prohibitive, 384, but it's still below the threshold. It's roughly about 1,000 ringgit. So yeah, if someone wants to invest 10 ringgit, maybe the argument holds water for StashAway. But then obviously it's a portion. But again, you have to remember, the lower the amount you invest in StashAway, the higher the fees, 0.8. So you have to take that into account. Yeah.
So I guess this doesn't apply to every investor. Maybe it depends on like the deposit size. If you're gonna make a 10,000 ringgit deposit anyway, you might as well consider your own, right? So the statement continues. Okay, with StashAway, you will benefit from the constant monitoring, rebalancing, and re-optimization we provide. Okay,
so here's my counter to that, and I know I'm going to get a lot of brickbats from StashAway fans. The rebalancing is already done by the index. Why do you think that the StashAway algo is much more superior? I mean, in the past, since they launched, I think if you've read news clippings or press releases by StashAway, they've already admitted that their algo, they made so much changes to their algo because it didn't work. And for me, it's very simple. The largest indexes of the world don't need much changes already. MSCI, or if you're buying a Vanguard S&P 500, let the index does it work.
Yeah. So perhaps it would be just better for us to learn about different indexes we're interested
to invest in. Right? Yes. There's no if anyone tells you they can time the market or whatever, my direct advice to you is to close your ears and run very far away. Now, I've just read a very interesting excerpt from a fund manager that I really admire. His name is Terry Smith. He's called Fundsmith. He's one of the best value investors out of the UK. And he actually likened investing to Tour de France. I don't know if you heard of Tour de France, Louis.
Yeah,
it's
I have that.
the cycling.
The bicycle one, yeah.
Yes. So Tour de France has different stages. You have the uphill, you have the speed, and then you have the flat lands. Okay. Now, most of the Tour de France winners, they not necessarily have to win every stage to win the Tour de France. You actually accumulate points and you become a specialist in one of the sectors. Either you are uphill climber, or you are time trial, or you are flatland kind of person, right? And he akin that to investing. He says if a fund manager is up all the time, something is wrong.
Makes sense. Mm.
You cannot be up all the time because you believe in a certain theme or a certain hypothesis. Like, for example, back when COVID just started and then the majority of the gloves was manufactured in Malaysia, obviously the glove guys flew. But now with the new Chinese players coming in, there's influx of supply. The glove industry has totally changed, right? Same as semicon. During COVID, everybody rushed out to buy a consumer electronic because they needed to do things from home, work things from home, right? Prior to that, the semicon industry or the electronics industry was chugging along at a certain percentage rate. But now with the accelerated buying because of COVID, there's no need for consumers to buy any more electronics. That's why the thing has slumped and it's going to be even more slumping. And that's what I'm excited for the clients that I'm managing money for, because I'm waiting for the slump to happen. And that's where you pick up cheap prices. But you see, if you are investing with the hope that it goes up like a linear graph, and you hope that your money is always at a certain level, I think that's false fallacy. So to your question about what is the value that these robo-advisories said about we're going to all rebalancing or all market optimizing, thematic, you have to accept the facts. Certain times your portfolio will be down. Why? Because there are things called market cycles.
So John, I think in that way we couldn't say that StashAway has an edge over this, right? Because it's like every fund management is the same, right? They try their best, but then their market cycles.
That's right.
Okay. So the last point here is, moreover, StashAway is able to offer fractional shares to make your portfolio more precisely allocated, which is nearly impossible if you were to do it on your own.
I think that will be an argument for direct shares investing versus ETF investing, because that is the same counter argument that if you buy an ETF, you're already buying fractional shares anyway. So I think that sorry,
not unique to StashAway.
Nope, no, it's not unique to StashAway. It's the same. It's the same defense that I would say against unit trust, because unit trust, you're also buying fractional shares, but you're getting you're getting unitization of your units in unit trust, ma.
That's true. Interesting point. I think when people think about StashAway, probably that's the closest product that they think about, right? Like StashAway, unit trust, but unit trust has higher fees, and the liquidity is much lower, So we know that StashAway isn't an asset class, right? But like what would be the difference? What's the difference between a StashAway and a unit trust?
Okay, I would say mainly what you've already mentioned earlier: fees. Second thing is, I think unit trust itself, you still mainly rely on what we call active management. That's why the fees are higher. So in a way, it's not fair, not entirely fair to compare unit trust to ETF or StashAway directly. Because technically, the unit trust company and the fund manager managing this unit trust, technically they should be doing bottoms-up fundamental research, individually picking stocks. Whereas if you buy into an ETF, they are just buying the stocks based on a basket of stocks based on an index. So there's actually no, in a way, technically, there's no research work done. It's purely based on an index. Whereas unit trust, why do you collect such high upfront asset under management fees? Is because the research work is done. You go visit companies, you study annual reports, or you look at, I don't know, they look at charts, whatever, and that in a way is the justification for them to collect the higher fees. So in a way, when you compare apple to apple, even though the asset class is the same, equities, but the method and the work to get to that decision is different. So when you're comparing unit trust to ETF, I think most people will say it's performance over the long run, because they say most active managers don't beat the index. So if you follow that belief, then ETF is the way to go. But if you believe that certain active fund managers, they are really doing their work, they are great ones, but they are not marketed properly, can do 15, 20% a year. Yeah, but they're not in the limelight, or they don't represent a company because they're boutique. That's why a lot of people don't know about them. I would, let me ask you, Louis, if someone has a track record of doing 20% a year, will you be happy to pay fees?
Yeah.
Precisely, right?
Pay like 2%, 5%. I mean, 20%. Yeah, true.
Yeah, but a lot of people, I understand, because I was a unit trust consultant before, and I couldn't bring myself to sell unit trust, because here I was getting my clients to, I only had 2 clients, by the way, myself and another friend, getting them to pay this kind of fees, but then the results did not substantiate that. You see? And that's where I feel that the ETF appeal is great. The stash away appeal would be those, for me, purely starting out, don't know what to do, want to get dip your toes in the water, start with this. Then as you spend more time understanding an ETF, I will highly encourage you to buy it yourself, because it's not as difficult as stock selection. And ETF is virtually just buy the S&P or buy the MSCI World Index. You don't need, for my personal view, you don't need all that rebalancing here and there, because the index itself will sort itself out. The rebalancing is already done by the index.
Makes sense. So in a sense, it's more of an ETF versus unit trust, right? Comparison, rather than stash away.
Correct. And you remember the deficiencies of buying through stash away or whoever like Endow Us or all these robo-advisors. You are buying and selling from them. You're not buying and selling from the open market. So you talk about liquidity. Let's just say, touch wood, any one of these companies go down, right? A stash away, whatever portfolio of ETF, it's recognizable only within the stash away ecosystem. But if you're buying and selling an ETF, it's in the open market.
True.
You can buy and sell based on an open market scenario, rather than, like it's the same argument for unit trust. If touch wood, either a public mutual or Affin or UOB who sold you that unit trust, if that company goes down, you can only buy and sell to that particular fund house, because so it's something that you have to think about. Obviously, the probability of any one of these fund companies or robo-advisor to go down is very, very minimal, but it's still a risk.
Still there. I don't. I think minimal, but not completely, not that zero.
Correct.
So in terms of the assets, we would rather compare like ETFs with unit trust. But then in terms of the risks, right, they're quite similar in that way, right?
Correct.
Because we're doing the assets through the stash away or the unit trust.
Correct.
Okay, but like another way for Malaysians to have forced savings is EPF. The EPF is one of the biggest discussions we always have. Yeah. I think it doesn't really enter the conversation when people think about stash away. They don't think about EPF. But in fact, when I look at it, it's almost the same. Right? You are depositing money in a kind of DCA way as well.
Yeah.
Correct me if I'm wrong, right? You are forced to deposit some of your salaries every single month into EPF, right? So, but their fees are lower. And if you look at the historical returns of stash away, it's kind of similar. Yeah. In fact, EPF performed better, I think, in the last 2 years compared to stash away. Yep. So what would be the similarity between stash away and EPF, and then the differences?
Okay. The beauty of EPF is it's much more diverse than equities, because you've got a big chunk of it is what we call fixed income, which is the Malaysian government securities. the bonds are virtually you're buying bonds that give you an payment of a coupon or an interest rate. Whereas if you go into StashAway, you can have a mixture of bond, ETFs, and all that, but you pay a fee upon a fee again. No? Okay. Second thing is, this is the con for EPF and a pro for StashAway. StashAway, they are not bounded by a mandate that you have to pay out a dividend every year. So obviously they are structured in such a way you get a growth. That means more equity, more long term. You're not worried about cashing out every year for a dividend, whereas EPF has that mandate. So that's a con for EPF and a pro for StashAway. Okay. The third difference I would say is this. The control for EPF withdrawal and deposits, you are still capped by a age limit, because you cannot withdraw everything from EPF until you're 55, or they may even increase to 60, whereas the control is ultimately in your hands for StashAway. So a lot of people don't think about control as a very important thing, but as investors, more and more, the value of your investments is very much also contained within the control element. Because if you cannot, let's just say property, you want to sell, but there's no buyer, it's tough because you need an agent and intermediary to find you a property buyer. But in the market, the moment the market is open, there's thousands of buyers and there are thousands of sellers, even millions and all the time. So price discovery, in and out, is actually very much more in your control rather than in the properties market. So I would say the same analogy for EPF and StashAway. StashAway has much more control. You want to in out very easy. EPF in out very, very tough. So that's the third. Last but not least is this. I think EPF has, because it's quasi-government, it has more of a social element to it comparatively to StashAway, which is very commercially run. So obviously, all these four aspects you have to take into consideration. Is not a direct apple to apple, but these are what I think the pros and cons are. You have a little bit of a social element. You cannot look too bad. Even the years of losses, you try to pay as much as dividend out as possible. Whereas StashAway, for reasons of profitability, they may increase fees and whatever. There's not much social element to it, lah. So you have to think of it that way as well.
So not just look at the returns, but there's also like so many other elements.
Correct.
I think interesting one is the control bit. A lot of people, like, sometimes they will say, oh, look at the losses on StashAway, I might as well have left my money in EPF. Right? So but then you also like the option of trading, selling your EPF shares, right, at the same time.
Yes. Yeah.
So I mean, like, that also brings to the point of like considering the safety of StashAway. It's still a startup of sorts. It's just launched in, I think, 2016, 17. Last year, in June of last year, they even had some layoffs. I mean,
so I'm going to give you is the money safe, is it, right? Does it matter? Like, do you think it's going to be a bank run? Excellent question again. Now you think about it, the one that creates the most value is actually not a distributor platform like StashAway. Yes, distribution is important because the Black Rocks wouldn't be like approaching you door to door trying to sell the ETF because it's in the open market, right? The real value is actually the ETF creators themselves, the owners of the ETF, the Vanguards of this world, the Fidelities, the BlackRock, right? All that. StashAway, in essence, is a distributor platform. You think of it like a Shopee lah. Shopee is they bring a lot of vendors together, and then they allow the vendors to sell their merchandises or services. The same like what StashAway does. They are bringing the BlackRocks, the Vanguards on all this, and they're selling to you as an aggregated platform for all these ETFs. Okay. Now, it is, for me, the value of a distributor is similar to what I will see as a trading company. You think about trading company, they buy and sell onions, right? What is their value? It's actually the network. And if somehow, I don't know, I'm looking for a very different or unique angle. Okay. So for me, right, if Affin or BlackRock or whoever, DBS or whatever, has a huge distribution network and they decided to do it in-house, they can replicate it much better than a StashAway, trust me.
That's
But
true.
StashAway, the real value is what? Is just the reach, social media branding, whatever, right? But the value of what they say, the additional value or their proprietary algorithm, all that kind of thing, I'll be honest, I'm not a firm proponent of that. They say that they have this modern portfolio theory. I look at the results. I mean, let the index do the balancing itself rather than your proprietary one. And you've changed it so many times, right? So your real value, if I were to be honest, is really just it as a distribution platform and a frictionless experience for the clients. So think of it as they are marketing. They're the marketers for you. So they help you do a little bit of this work operationally. So that's where the real value of StashAway is. So yeah, by that, what kind of valuation you want to bestow upon this company, I leave it to the audience to think about it.
Yeah, I think you have to make that analysis and conclusion yourself.
Yeah.
StashAway also like has this index, their StashAway risk index. Okay, so I don't know how can we look at risk index? Maybe you can also share with me. How can we look at risk index?
Okay.
What is a risk index? Yeah.
In finance school, they will teach you a risk index is this thing called beta or volatility. That means the more volatile a stock is, or the more volatile a share price movement or an index movement is, the more riskier it is. Now, if you ask any true value investor, and I'm talking about not just from me, but from the greats, finance school will teach you risk equals volatility. Value investors will teach you risk equals permanent loss of capital. Now, I want you to sink that in. Very different, huh? What is the permanent loss of capital? What does it mean, right? So, finance school will teach you, wow, because this stock goes from 50 cents to $5 and then back to 60 cents, right? That's risky. But what impacts that is actually just a perception of the market. People are bidding and selling. The prices move. Does it really matter to the business itself that the price has fluctuated so much? During the dot-com bubble, right? Amazon, which was like growing revenue, growing sales, growing free cash flow every year, right? The share price dropped by 90%. But sales, net profit, everything was still growing. But the share price dropped by 90%. So is that true efficient market? No. It's a perception because everyone was fearful. Everything to do with internet, all share prices was dropping, including Microsoft, right? So how can you base risk based on just the fluctuation and the volatility of the share price? Nothing to do with the business. So when we talk about permanent loss of capital, risk is, do you understand this business? Are they going to be profitable in the next 5 years, 10 years? Are they going to generate free cash flow? If you make a wrong decision, that means you didn't select the stock properly or you didn't select the business properly. That is a permanent loss of capital. That is, for us as value investors, that is risk, not volatility of the share price. You see the difference now? I know it's a little bit deep, but
it's like, John, it's like, oh, here's an onion, then you peel open another onion.
So it's like this. Let's just say you run a coffee shop, Louis. On the onset, people never seen your accounts. Today, it's raining, not many customers. People want to sell your coffee shop. But if it's on summer, there's a lot of customers, then people say, hey, how much do you want to sell your coffee shop? So the prices goes up, right? Okay. But you know that, hey, during rainy days, how do you know I'm not getting Grab delivery being sent? How do you know people are buying? You don't know because you've never seen the accounts. You're just looking at the footfall of that one, and people decide the price of your coffee shop based on that.
Yeah, makes sense.
Correct?
Makes sense. So I mean, how does it like link back to the risk index again? I think I lost track
for me, the risk index of StashAway is based on volatility again.
Okay.
Which is not linked at all to permanent loss of capital.
I see. Okay, so there's like this thing they call like value at risk. Is it the same thing?
No, it's not the same thing. Value at risk. Because you see, again,
Because
what
our
is the
own-
criteria is mainly based on price,
Ah,
market cap. Because market cap is a function of price, ma. You think what is the formula for market cap? Price multiplied by number of shares. Does it has to do anything with sales?
interesting. And
Net
it's
profit?
interesting because they came up with this name themselves, right? Value at risk, and they gave themselves their own figure. 99% VAR.
Again,
Value in this can people do this? Can they
they
give
can.
themselves?
I mean, people have
Okay.
written PhD theses about modern portfolio theory, about even even this thing called CAPM, capital asset pricing model, which they try to mimic risk, right, by mathematical formulas. For us, is this. I put it very simply. Let's go back to the coffee shop thing again. Let's just say you're the owner of this coffee shop. Someone tried to mathematically correlate the value of their business. Okay. But
Okay.
Louis, okay, I'm going to paint you a little bit bad light. You are dishonest, you are deceitful, you actually siphon off money and all that kind of thing. Okay. But on the surface, wow, you see sales every day, you see everything.
Yeah.
Every other month you have new renovation, you're always in trend, and your coffee shop looks great. But at the back, you're a deceitful, dishonest person. Now, if I know your character, would I invest? I wouldn't. But on the facade, I look at your coffee shop, wow, a lot of footfall, a lot of that one, right? And every day people are outbidding to buy your coffee shop because the price is like, oh, Louis, I'm offering 1 million. Next guy is going to come at 2 million, 3 million. The price goes up. You see? So how is it all linked to what you just asked about, value at risk, whatever? Again, if you're looking purely based on price, that was the facade that we're talking about. But if you talk about real risk, is permanent loss of capital, is how to evaluate you. You are the person running the business. Is your business healthy? Is your receivables healthy? And all that, you see? But obviously...
So like anytime we use an index, we're using a mathematical model to calculate the risk, is it?
Precisely.
Ah, okay, I got it. So whatever we see here would be more of a quantitative view
because
rather than qualitative.
The qualitative views, how do you put it into a black box, a mathematical model? It's tough.
True.
That's why when a lot of people say active investing and management is dead and passive investing is the way to go, I personally disagree with it. Obviously, a lot of people say that, oh no, because the fees are cheaper. Yes. But again, it boils down to you. If you don't want to understand, you don't want to take time, passive investing is the way to go. Lower your fees, go for it. Do you need an intermediary like a robo-advisory? Maybe in the beginning, when you don't understand all this, you want to dip your water to understand, go ahead. But I highly encourage you to level up. It takes probably a week, the most a month. Understand what's an index. Understand how to buy from a foreign broker. Today is so easy, right? Yeah.
I mean, it's a lot of money at stake, right? So I think it makes sense, right?
Correct.
If you want to buy a house, you have to spend as much time or even more to analyze the pricing, and look at the location, etc. I think it's also worth it for ETFs.
Correct.
So what do we do with the value that they've given us here, 99% VAR? So which is which can be interpreted, they say, as a portfolio having a 99% probability of not losing more than a given percentage of assets in a year. It's a lot of words that I don't understand.
Yes, actually, it's it's a lot of mumbo jumbo, to be honest. Again, come back to what I said. If your portfolio is green for 20 years, I would question the philosophy and the hypothesis of the investing portfolio. The method is how it's structured. Because you see, the way it's calculated is the way it's marketed. It's like 99% of the time you won't lose money. Okay, that's how I read it. 99% of the time you won't lose money. How do I can even go a little bit further. Why don't I ensure you 100% of the time you won't lose money? How do you do that? Buy fixed D, 3%. You won't lose money, ma.
True.
How do you quantify that? I mean, right? So I know it's a lot of jargon. I know I'm going to get a lot of brickbacks, which I don't really care. But again, I look at it is, if you're buying broad base, There are times when the market is up, there are times when the market is down. Any algorithm to try to prevent losses, paper losses for a temporary period, I think is an exercise in futility. Just take it as part of the game. As long as you don't cash out during those bad times, because you know you're buying, hey, you're buying the S&P 500, you know, you're buying Apple, you're buying Microsoft, you're buying, yes, there are times when there's market correction, but why do you need to correct your portfolio to make sure your portfolio looks green all the time?
That's interesting. That's interesting. So
you see what I'm trying to say? Like, you should be buying more. When it's red, you buy more and more because you're buying into great companies. But when you try to balance your portfolio to make your portfolio green all the time, are you sure that's the right way to invest or not?
Makes sense. But I think that because of the market they're trying to appeal to, again,
correct,
people
precisely.
who may not even understand what they're buying, right? So they think, okay, I mean, I've seen some, you know, reports, just some videos going around, people lost money, 20-something%, 30%. So there's still some amount of blame that people attach to StashAway making some wrong decisions.
Yes.
Yeah. So
I pity their position also, because all fund managers go through the same thing. So
yeah, but maybe even more because of how they've marketed it, you know.
Correct.
So, well, maybe I mean, from what I can gather from this is that we should buy things that we understand, lah. So we understand why it goes down, at least.
Correct.
And maybe understand that, you know, it's just part of the cycle.
It's part of the game.
Yeah.
You see, the market is so funny, Louis. When market is up, everyone wants to come in. When market is down, no one. So it's like, actually, I want to borrow you know, I love analogies, right? And I'm going to borrow this quote from Peter Lynch, right? The stock market is so funny comparatively to the hypermarket. In a hypermarket, when there's a sale, everyone rushes to it. But when the stock market is sale, everyone runs away.
True.
Yeah. So you look at Google.
So I'm just thinking, like, what if everyone runs away, right? Can like, what if everyone runs away from StashAway? Is there potential of like a bank run sort of situation? Actually, it's not a bank, right? It's not. But
again, great question.
Withdraw.
Withdraw all. I don't think, in my opinion, I don't think there will be a bank run in a sense, because it's not operated like a bank. It doesn't. Yeah, but in terms of portfolio withdrawal to a low level, there is always a possibility, because as you know, I was in the US recently, attending Berkshire Hathaway's AGM and also a few value investing conferences along the way. I met a fund manager, hedge fund manager. He presented, right, at the peak of his career, he had 20 billion asset under management. At the low point of his career, he had 1.9. That means he had a 90% withdrawal.
Oh, wow.
So at the peak of the career, he was, and mind you, 20 billion, StashAway's entire AUM is only 1 billion, you
know. Yeah.
So withdrawal possible. Will he have a bank run like a bank because their fear deposits are lost whatsoever? I think a little bit more unlikely, because they don't function like a bank. They're not giving risk-based products. They're not giving out loans or whatsoever, because loans is payable, right? Yeah, so I think a bank run on them is very, very unlikely in that case.
So probably the biggest like risk, if let's say I invest in StashAway, would be just loss of money in fees.
Loss of fees. Yeah. And as the audience of StashAway matures, I think that's where I think it's not so much on getting new money in. I think it's the retention of it. Because if alternative products are being shown to them, like for example this episode, and people start reading up more about ETFs, that's where the problem for any robo-advisor will come into play, the retention of them, because they are smarter, and consumers will get smarter. What did they say? Consumers will get smarter, right?
That's right. I mean, information is free. So as long as I think they will start to question when they start to see the losses, which people don't expect that because that was not explained to them.
Correct.
Right? They didn't
Precisely.
understand that as part of their investing journey.
Correct.
Okay, so I think we had a great discussion around this. Let's wrap up with one case study of this Malaysian guy, Malaysian Redditor, who's asking this very interesting question. So on this Reddit thread, right, it says, can I treat StashAway as my saving account? Interesting, right?
Yeah.
I'm currently working with take-home salary of 3.6K.
Yeah. And then monthly expenditure, 600 ringgit for the MyV. Yeah. Have you got it?
Actually, clicked away. Okay, let me reread.
Yeah.
I'm currently working with take-home salary of 3.6K. Monthly expenditure, 600 for MyV loan, 300 allowance for my parents, 700 food and petrol. I have 2K extra. I'm interested in putting 2K each month to StashAway. I checked the website. It said it charges 0.1 conversion rate, so I'm not sure if it's a big deal as I favor liquidity and at the same time want my asset to grow through StashAway. Is there any catch of using StashAway this way?
Okay, there's a lot of catch. Okay, okay.
Wow.
I'll go through the few risks that already.
Wow.
Number one, right? My guess is this guy doesn't yet have a 6 months what do you call it, buffer for his rainy day budget. Second thing is when you are putting into StashAway, it's not protected by PIDM.
True,
you think about it.
True.
It's not protected by PIDM. Yes, you may have a little bit higher yield compared to the banks, but if StashAway collapse, then that's it. There's no deposit protection for you. Okay. The third thing is you are at the risk of currency conversion. There's 0.1%, but you're buying into a high US dollar today. Now, if the de-dollarization actually happens where a lot of trade is actually done outside the US dollar and the US Federal Reserve stops raising interest rates, which actually is a checkpoint for the weakening of the US dollar. What if the US dollar comes down to 4.3 or 4.1 and you converted at 4.5?
Wow.
You think about it. So yes, if you want to keep it in US dollar and not spend in Malaysian ringgit, you're fine. But if you want liquidity, which this guy wants, you converted at 4.5 and now you have to convert back at 4.1. Isn't that a risk? So you have, one is PIDM protection risk, which you are already foregoing. Second thing is your currency conversion. If you need it as liquidity, keep it in the same currency rather than going to a foreign currency. Only excess money that you know you're not going to touch whatsoever, that's where you put it. You soak it away into a different currency. You see? Yeah, but again, he wants it for liquidity. So I'm answering specific for this case. You know, rather than have the 2K go into StashAway, you have 1K into a fixed D or something in a local bank, and then a 1K which, you know, is really to grow your asset into a StashAway or into an ETF directly. I think that's a better way of segregating. Because you can, I know, you know, most people, they don't have the time, don't have the tenacity to go and read and understand. And I hope this Redditor, reasonable can. Yeah, I hope you're reasonable enough to actually to read up a little bit, educate yourself to elevate rather than, you know, just, yeah, I think it's very risky to put 2K straight into StashAway. You don't even have the insurance protection, you're the risk of currency conversion. And can you imagine, he didn't even mention StashAway Simple or StashAway whatever, you know. So what if he just went to buy the StashAway fully equity, 99% equity and all that? Yeah, then even when you want to liquidate, you're at the down on the market. Yeah, and so that's where they will start bashing StashAway. Hey, how come this is, you know?
Also, so you see, 2K each month is like 24,000 a year. So for, I think 3.6K will be more on the entry level kind of and we don't know what maybe they're saving up for something, maybe. So
yeah.
So I mean, but my question would be like, would it actually be wise to put like 50% of the access into ETFs at this point?
I don't think so. I think again, always build up that 6 months, because like for example, you have MyV, okay? Touch wood, touch wood. A car repair will already set you back a few thousand.
Sure.
Where are you going to get the money? Any life incidents that maybe a major thing will already set you back a few thousand. So if you haven't even got your 6 months, right, I think it's I learned it the hard way actually. But I've buffered myself with enough insurance, buffered myself with not buying expensive cars to maintain. Like if you buy a Continental car, my God, just be prepared.
Yeah.
20, 30K put at the side one.
Yeah.
Right.
Yes.
I just buy simple Japanese cars. Touch wood, my car has never, the only thing I've changed is like wear and tear stuff, like the wheel, the bearing, right? So again, it boils down to your lifestyle, but I really think that 6 months buffer is more than important before you start, thinking about long-term asset accumulation, investing, and all that. Yeah.
That makes sense. Okay. So I think we have discussed most. We cannot discuss everything. There's a lot of different aspects to investing in StashAway. We have not touched on StashAway Simple. That's a different discussion altogether.
Right.
I think what we want to bring up with this episode are the fundamentals around investing in StashAway for anyone who's interested to do it for the first time. So I mean, to wrap up, John, what's your final verdict on StashAway? Who should invest in it? Who should not invest in it? What are the alternatives out there?
For those guys who have never invested in anything before, I rather than buying into an insurance saving plan or a unit trust, start with StashAway. Once you dip your toes in the water, start reading a little bit about ETF. It's not that difficult, guys. Trust me. Okay. Then start understanding how you can buy your ETF directly. Okay. Then if you feel that this is kind of your cup of tea, then only start exploring, maybe even active fund management. Find a good manager that can invest for you if you don't do it yourself, or even better, do it yourself. But I know most people, they'll be bogged down with family, with a career, whatever lah, right? They want to pursue their own passion, guitar, music, whatever. And that's where, I think finding someone that is in line with your life philosophy to manage money for you, I think is a fair price to pay. So that would be my simple steps. Deep water in StashAway. Go for your own ETFs, okay? And if you want a little bit more, bang for your buck, either do it yourself and spend a lot of hours. Trust me, it's not going to be easy. Spend a lot of hours understanding the tenets of value investing and all that, or get someone to do it for you for a very nominal fee. Trust me, it's well worth it. I mean, I've gone through all stages myself, and I think looking at it, sometimes it's better to outsource when you entangle and disentangle all the emotion that you will feel when you do your own investing.
So it's a progression, right?
It is a progression. It is a progression. Yeah, but don't stop. Don't you buy into StashAway and that one all and be all. That's it. Yeah.
Like keep DCAing until 10 years later.
Yeah, exactly.
I think
don't take away for it. No, blame yourself because you didn't upgrade yourself.
Right. So good start, but don't stay there for too long, because ultimately you're still investing in the same asset class, right? ETFs.
Correct, which is equities.
Correct. And then ETFs again, then are investing in equities, right? So maybe slowly understand the fundamentals of how to do it. Okay, so thank you so much, John, for sharing your insights. I think the audience have a lot to take away in this episode. However, I think if you have more questions around like what around StashAway itself, like investing in it, some terms around it, you can always share them in the comment sections below, and John will try to answer them, and I will if it's something I can answer.
No, please, Why not? Yeah. Why not? Louis, go ahead and answer.
Yeah. So if you like content like this, make sure to give it a like and then subscribe to our channel for more content. Yeah.
Yeah.
Thank you so much, guys. Bye bye. See you in the next episode.